Imagine waking up to find your life savings gone. Not just from stocks, but from your bank account too. Between 1930 and 1933, 1/5 of all U.S. banks failed, taking people's deposits with them. This is the story of how banking panics shredded lending capacity and deepened deflation, creating a downward spiral that crushed spending and investment. What if everyone around you seemed to be getting rich, but their wealth was built on borrowed money? The 1920s presented this exact illusion, a surface-level economic boom that masked deep structural weaknesses. Factories produced consumer goods at record rates, and cities expanded with new construction. Stock prices climbed steadily, creating an atmosphere of limitless opportunity. Here's the thing. Much of this apparent prosperity relied on credit. Many Americans bought stocks using margin loans, putting down just a fraction of the purchase price. This meant ordinary households could suddenly participate in market gains, but it also tied their financial security to continuing price increases. If stocks fell even a little, those loans would need immediate repayment, forcing investors to sell. Beyond the stock market, consumer habits shifted toward durable goods like automobiles and electrical appliances. Families purchased refrigerators, radios, and cars using installment plans, committing to monthly payments they might not sustain if incomes fell. This created a cycle where production kept rising to meet demand that was itself dependent on continued access to credit. Not everyone shared in this apparent prosperity. Farmers faced declining crop prices throughout the decade, and rural communities saw little of the urban economic excitement. Industrial workers experienced wage stagnation even as productivity increased. The wealth gap widened, leaving many households vulnerable to any economic disruption. The entire system resembled a pyramid of confidence. Each layer of spending and investment relied on the stability of the layers below it. When that confidence wavered, the structure had no solid foundation. Banks had lent heavily against stock collateral and consumer debt, linking their stability to the continuation of the boom. This pattern of borrowed prosperity isn't just history. Modern financial systems still create similar illusions through leveraged investing in consumer debt. The lesson from the 1920s isn't that growth is bad. It's that growth built on debt requires careful management and constant vigilance. Understanding how paper wealth can mask real risk helps us recognize similar patterns today. The stage was set for a disaster that would reveal how fragile this economic model truly was. When confidence finally broke, the consequences would spread far beyond individual investors to affect the entire banking system and global economy. How does an 80% market collapse actually feel when it's happening day by day? October 1929 began like any ordinary autumn on Wall Street. Markets had shown minor dips before, but nothing signaled the coming disaster. Then on October 24th, Black Thursday, prices began falling in a way no one had experienced. Sell orders flooded the exchange. Tickers lagged hours behind actual trading. Within days, a stunning pattern emerged. Each drop triggered margin calls. Investors who bought stocks with borrowed money now had to repay loans they couldn't afford. This created a vicious cycle. Forced selling pushed prices lower. Lower prices triggered more margin calls. More selling followed. The market began feeding on itself. Panic spread from the trading floor to Main Street. Small investors watched life savings dissolve in hours. By the following Tuesday, the floor turned chaotic. Blue-chip stocks lost a third of their value in days. Brokers shouted across the room. Paper slips piled up unattended. Wealth that felt solid Monday turned to dust by Friday. Here's the thing about paper wealth. It exists only as long as people believe it's real. When confidence broke, everything changed. From its peak in 1929 to its lowest point in 1932, the market lost over 80% of its total value. Companies that seemed unstoppable became nearly worthless. Household names lost almost all shareholder equity. The psychology shifted instantly from optimism to raw fear. People who felt rich one week stood in line for soup the next. This crash wasn't just numbers on a board. It was the evaporation of security and trust. Retirement plans vanished. College funds disappeared. For many, decades of work dissolved in days. The impact reached beyond stock owners. Banks that lent to investors faced massive losses. Businesses that depended on consumer spending saw demand collapse. The shock revealed a hard truth. Perceived wealth can disappear faster than it formed. What felt like a permanent boom proved to be a fragile illusion. The crash demonstrated how quickly confidence can unravel when built on borrowed money and speculation. Understanding this pattern helps recognize modern market risks. Rapid price increases driven by leverage often end the same way. The sudden change from greed to fear remains a constant in market psychology. This decisive event didn't just reset stock prices, it reshaped how people viewed risk, trust, and economic stability for generations. The aftershocks would soon ripple through the banking system, exposing even deeper vulnerabilities. What happens when the institutions you trust with your money suddenly vanish? The banking system of the 1920s had grown deeply intertwined with stock market speculation. Banks lent heavily to investors buying stocks on margin, using those same stocks as collateral. When stock values collapsed, those loans became essentially worthless. Banks found themselves holding promises to pay that nobody could fulfill. This triggered the first banking panic in late 1930. Customers rushed to withdraw their deposits, fearing their bank might fail. These runs created immediate cash shortages. Banks that seemed solvent one day could be empty the next. The system had no insurance protection for depositors, so people lost everything if their bank closed. Between 1930 and 1933, 4 distinct waves of banking panics swept across the country. Each wave followed a similar pattern. Rumors would spread about a bank's stability. People would line up to withdraw funds. The bank would exhaust its cash reserves and close its doors. Other banks would then face suspicion and renewed withdrawals. By 1933, approximately 1/5 of all U.S. banks had failed. That's nearly 11,000 institutions out of business. The money supply contracted by an estimated 31% during this period. This meant there was literally less money circulating in the economy. Businesses couldn't get loans to fund operations. Families couldn't secure mortgages or credit. The banking failures didn't just erase paper wealth, they destroyed the system's capacity to create new credit. Banks serve as intermediaries between savers and borrowers. When they fail, that connection breaks. Productive businesses can't expand. Home buyers can't purchase houses. Economic activity slows dramatically. Here's the thing about credit contraction. It creates a downward spiral. Less lending means less spending. Less spending means lower business revenues. Lower revenues mean more layoffs and bankruptcies. This cycle deepened the economic downturn significantly, turning a stock market crash into a full-scale depression. The banking crisis demonstrated how financial institutions can amplify economic shocks. What began as a problem for investors quickly became a crisis for everyone. The system's interconnectedness meant weakness in one area could threaten the entire structure. This pattern still exists in modern banking, though with different safeguards in place. Understanding this domino effect helps explain why financial regulation matters. Banks aren't just places to store money. They're fundamental to economic functioning. When they fail, the consequences extend far beyond individual account holders. The credit contraction of the early 1930s showed how banking stability directly affects Main Street businesses and household financial security. How did a problem in American banks become a worldwide economic disaster? The answer lies in an international monetary system that connected every major economy like links in a chain. Throughout the 1930s, most countries operated on the gold standard, meaning their currencies had fixed values relative to gold. This created a rigid framework where economic troubles in one nation could quickly spread to others. When American banks began failing and the U.S. economy contracted, gold started flowing out of the country. Foreign investors pulled their funds from American assets. International trade balances shifted dramatically. This movement of gold triggered automatic responses from central banks worldwide. To defend their gold reserves and maintain currency values, they raised interest rates. Higher rates made borrowing more expensive, which reduced business investment and consumer spending. Britain, France, Germany, and other industrial nations all followed this pattern. They prioritized maintaining the gold standard over stimulating their economies. This meant implementing deflationary policies during exactly the wrong time, when economic activity was already slowing. Instead of increasing money supply to counter the downturn, they tightened financial conditions further. The global deflationary framework amplified the American contraction like an echo chamber. As each country raised rates to protect its gold reserves, they collectively deepened the worldwide slump. Manufacturing nations saw export markets disappear. Agricultural producers faced collapsing commodity prices. Creditor countries demanded repayment of loans that debtor nations couldn't afford. Domestic policy errors in multiple countries worsened the situation. Many governments cut public spending to balance budgets during the downturn. They increased taxes to cover revenue shortfalls. These orthodox economic measures only deepened the contraction. The belief in sound money and balanced budgets prevented more aggressive counter-cyclical policies. The gold standard served as a transmission mechanism for economic distress. It created a system where no country could easily escape the downward spiral. Attempts to stimulate one economy would cause gold outflows, forcing contractionary measures. This interconnected reality meant that unilateral action couldn't solve the crisis. International cooperation might have provided a solution, but distrust and nationalism prevailed. Countries focused on protecting their own interests rather than coordinating responses. The lack of global leadership left the system trapped in a destructive pattern. Economic nationalism replaced the cooperation that might have mitigated the damage. This experience demonstrates how monetary systems can create vulnerability through interconnection. Fixed exchange rate regimes like the gold standard can transmit shocks across borders. They limit policy options during crises by prioritizing external stability over domestic economic needs. The lesson remains relevant for modern global financial systems, which still face similar coordination challenges during international economic stress. The crisis showed that economic problems don't respect national boundaries. Solutions require either international cooperation or mechanisms to isolate domestic economies from external shocks. The gold standard's failure during the Depression led to its eventual abandonment, but the fundamental challenge of managing global economic interdependence continues to shape policy decisions today. What happens when countries suddenly stop trading with each other? In 1930, the United States passed the Smoot-Hawley Tariff Act, designed to protect American farmers and manufacturers from foreign competition. The law raised import duties on thousands of goods, making foreign products more expensive for U.S. consumers. Supporters believed it would shield domestic jobs and industries during tough economic times. Here's the thing. Instead of helping, the act triggered a wave of retaliation. Other nations quickly imposed their own tariffs on American goods. Canada raised duties on U.S. products. European countries followed with similar measures. Within months, a global tariff war had begun. Countries that depended on exports saw their markets shrink overnight. The goal had been protection. The result was isolation. Global trade collapsed by approximately two-thirds between 1929 and 1933. This decline far outpaced the overall economic contraction. Ships sat idle in ports. Warehouses overflowed with unsold goods. Farmers who produced for export watched prices plummet as markets disappeared. The collapse in trade deepened the worldwide economic slump by severing connections between producers and consumers. Balance of payments problems worsened dramatically, especially for nations that exported raw materials. Countries like Argentina, Australia, and Brazil relied on agricultural and mineral exports to earn foreign currency. When trade barriers went up, their incomes dropped sharply. They couldn't afford to import manufactured goods, which hurt industrial exporters in turn. The cycle of reduced trade amplified economic distress across continents. Protectionism accelerated the global downturn without solving domestic issues. Higher tariffs didn't save American jobs. They reduced export opportunities for U.S. industries. Farmers lost foreign buyers for their crops. Manufacturing firms faced higher costs for imported materials. The policy demonstrated how economic nationalism can backfire, hurting the very people it aimed to protect. The trade collapse showed that during a global crisis, turning inward often makes things worse. By reducing economic cooperation, Countries magnified the Depression's impact. The lesson remains relevant today. Trade wars seldom have winners. Understanding how protectionism can deepen economic trouble helps explain why open markets matter, especially during difficult times. The impulse to build walls often isolates economies when connection is most needed. How does economic theory translate into daily hunger and homelessness? Unemployment rates reached levels never seen before. People who had worked their entire lives suddenly found themselves without income. Basic necessities became difficult to obtain for millions. Long lines formed outside soup kitchens, where charities offered simple meals. Families stood waiting for bread, knowing this might be their only food for the day. Here's the thing about losing your home. It's not just about shelter. Families faced foreclosure and eviction with nowhere to go. Farmers watched bankers auction land that had been in their families for generations. People moved in with relatives, creating overcrowded households. Some built makeshift shelters from scrap materials. Others simply lived on the streets. The psychological impact extended far beyond financial loss. People who had provided for their families now felt powerless. The constant search for work wore down self-respect. Men who couldn't find jobs faced damaged identities as providers. Children went to school hungry and without proper clothing. The stigma of poverty created social isolation, even among former friends and neighbors. Social structures strained under widespread need. Local governments struggled to provide relief with shrinking tax revenues. Private charities became overwhelmed by demand. Communities fractured as competition for scarce resources increased. The crisis affected different groups unevenly. Minority communities faced even higher unemployment rates. Older workers found it nearly impossible to get rehired. Young people entering the workforce had few opportunities. The Depression redefined what economic security meant. People who had never worried about food or shelter now understood how fragile security could be. The experience created lasting changes in how Americans viewed government responsibility. It showed that individual effort alone couldn't always overcome systemic economic failure. This period demonstrated that economic statistics represent real human experiences. Percentage points of unemployment meant fathers walking miles to seek work. Bank failures meant families losing their life savings. Trade collapses meant farmers watching crops rot without buyers. The human cost extended beyond material deprivation to include lost dreams, broken families, and diminished hope. Understanding this connection helps explain why economic stability matters. It's not just about numbers on charts. It's about people's ability to feed their children, keep their homes, and maintain dignity. The Depression taught that economic systems should serve human needs, not the other way around. How does a global conflict ultimately solve an economic crisis? World War II required mobilization on an unprecedented scale. The shift from civilian to military production transformed factories overnight. Automakers built tanks instead of cars. Apparel manufacturers sewed uniforms instead of dresses. Electronics firms produced radios for bombers rather than household consoles. Defense-related employment created millions of well-paying jobs almost immediately. Shipyards needed welders and engineers. Aircraft plants hired machinists and assemblers. Munitions factories required chemists and quality controllers. The unemployment that had plagued the nation for years virtually disappeared as production priorities changed. Workers who had stood in bread lines now earned steady wages building warships and aircraft. Industrial capacity expanded dramatically to meet wartime demands. New factories were constructed across the country. Production methods became more efficient through standardization and assembly line techniques. Output increased so significantly that the United States could supply not only its own military, but also support allies through Lend-Lease programs. The economy shifted from relief mode to full production capacity. Aggregate demand increased through massive government spending. Defense contracts pumped money into communities that had struggled for years. Wages circulated through local economies, supporting businesses that had survived the Depression. This created a multiplier effect where each defense dollar generated additional economic activity. Consumer spending rose as households regained financial stability. The economy transformed completely under wartime pressures. Shortages of consumer goods actually helped sustain the recovery by limiting inflationary pressures. Rationing ensured equitable distribution while directing resources toward military needs. Women entered the workforce in large numbers, taking jobs in industries that had previously excluded them. The war effort created economic opportunities across demographic groups. Wartime mobilization provided the decisive cure to Depression-era weaknesses. It demonstrated how sustained demand can overcome economic stagnation. The experience showed that large-scale government spending could stimulate production and employment effectively. This lesson influenced economic policy for decades afterward, shaping approaches to recession management and public investment. The war's end brought new challenges as the economy transitioned back to civilian production. But the fundamental lesson remained clear: adequate demand drives economic activity. Understanding this connection helps explain why controlled spending during downturns can support recovery. How do patterns from the 1930s appear in modern economic systems? The concept of fragile wealth illusion remains just as relevant today. When asset prices rise rapidly through credit expansion, they create a false sense of security. People see values increasing and assume the trend will continue. This mirrors the 1920s pattern where borrowed money inflated stock prices beyond sustainable levels. Margin buying and leveraged investments continue to pose significant risks. Using borrowed money to invest amplifies both gains and losses. Modern trading platforms make leverage easily accessible. This can accelerate market downturns when prices fall, similar to the margin calls that worsened the 1929 crash. The Great Depression reminds us that economic stability depends on recognizing fragile illusions before they collapse. The crisis showed how quickly prosperity can disappear when built on borrowed money and speculation. Apply this critical perspective to your financial decisions today. Question investments that seem too good to be true. Build savings that don't rely on market optimism. Understand that real security comes from recognizing risks, not ignoring them.